Hey, how's it going? I'm Mr. Jerry Caius, and I'm going to take you through the stock market crash of 2018. All right, let's get right to it. So we're going to be talking about this crash of 2018, which occurred in the fourth quarter of the year. And this is particularly interesting because as it unfolded, everybody was wondering what exactly is going on. And this is what we want to talk about. So over the years, over the millennia, over the history of the stock market, there have always been crashes. So what is happening right now is not something new. Everything that happens is always something that's happened before. In the book of Ecclesiastes, nothing is new under the sun. What has been is what will be. So the same thing is happening in every stock market crash. So the factors might be different, but the effects are always the same. Or the effects might be different, but the factors are always the same. So you need to know what is underlying in whatever is going on. So 2018 is particularly interesting because it showed us something that is unique to the stock market and something that we should continuously look forward to in the next crashes so that we know exactly what is happening. So this crash categorically cannot be as bad as the crash that happened before. So the crash that previously happened was in 2007, which is 2007 to 2008, around 2009. This is when the market started to recover again. So this is not going to be as bad. Why? Because people still remember the crash of 2008. So this is not going to be as bad just based on that fact. So a crash that happens in a really horrible way is something that catches us by surprise. So this market crash of 2018, of course, caught people by surprise, but it will not, it can't be as bad as the previous one because it's still fresh in our minds. And this is usually how these markets work. So let's get right to it and get to the details. So generally, what is a market crash? So there isn't a proper definition of what a market crash is because it could go either way in the coming future. But when we speak about a crash, what we're speaking about is a double-digit drop in the value of a stock or a market or an index or a country, an economy. It has to be a double-digit drop in a short period of time. So this is also important that it has to be in a short period of time. So this is what a crash would be instead of a recession. So a recession is something receding, which means something going backwards. So a recession usually takes a longer time than a crash. A crash is immediate. So we have a double-digit drop, right? And we classify that as a crash. So it could be something like 10% or more, but usually we're looking at something like 20%. This is where crashes usually find their resistance or support, 20%. And sometimes you'd find that they will find their support at 80%. So that's the Pareto principle in terms of market crashes. But generally speaking, 20% or something like that would classify that as a crash, and 20% drop in a short period of time. So crashes are caused by social, political, economic spheres, attitude, and sentiments. So the market is a product of society and it's influenced by politics within the economy. So society is the market participants. So you have to realize that the herd mentality, this is what usually leads a crash. And when people are panicking, when people have fear, greed, or whatever, anxiety, they tend to act irrationally. So this irrationality, this lack of rationale leads to a positive feedback, actually a negative feedback, where the selling keeps on propelling because more people are selling. So this feedback loop is what makes a crash propel. So a market crash is just a bubble that occurs in the opposite direction. So the same type of emotions, the same type of euphoria is experienced only inversely. So this feedback loop is what causes a market crash. So society and the minds of the people who are experiencing the crash were turned to force this feedback loop, which keeps on propelling this negative feedback. So the first crash was from the first stock market that was established, which was the Dutch stock market, and there was a tulip bulb mania. So there's more details on that one, but the same social, political, and economic influences and factors are what caused the first crash, and these are the same things that are causing this crash. So whenever we have a crash, this is what we're looking at. We're looking at a double-digit drop, and we're looking at the social, political, and economic spheres, and we're looking at what sort of feedback loops can be affected by this type of action. So let's drill deeper into this market crash in particular. So when did it really start? So it started on the 21st of September 2008. So this is when basically the market started to show some weakness. So this is not exactly the start where the market started to drop, but this is when it started to decline. So let's take a closer look at what we're going through here. So this is a snapshot of my chart on Tradingview.com. So if you want to check that out, you can. So here is what we're currently explaining and what happened. So this is something that I posted, and when I posted this, the idea was that in this golden area here, if the market if the market actually breaks through this area, then we are in a bearish market. And this is exactly what happened. Before, of course, it broke it, and when I posted this, the market was right there at 2632. So when it broke this area, this is when the collapse started. So this is when I would say we entered into bearish territory. So this is just your old support and resistance, and also, of course, other fundamental influences and technical factors that you'd consider when you're entering this position. But this area was when the market actually started to crash, because what we're looking at here, let me just make sure that we are on the same page here. So I wanted to point up. So here, what we're looking at is this area, right? And then what I want to point out to is this particular candle, the green one, is showing this particular wick, and the wick is showing that there was a bounce at that area, but the market ended up collapsing and crashing at this zone. So this is a weekly chart, so it's showing weekly movement. So each candle is representing a week. So in all of these weeks that ensued, the market tried to rally up, but this is the top that the market found. So from this top, the market started to crash down, and the market had been going up for years. So this is what happened, and now we have experienced the crash after this had occurred. So let's get a little bit deeper into the factors that we are looking at. So the plunge that happened after that area that's highlighted on the chart caused the NASDAQ to enter bearish territory. So this is the first bear market since 2007 to 2009. So this is why we're referencing the previous crash, because whenever we're looking at price, what we're actually looking at are highs and lows. This is what we're looking at. So this is why we're referencing the previous high and the previous low. So in the fact that, in the case or in the possibility that the market actually goes lower than 2007, 2009, this is going to be very, very catastrophic for the entire world, because I can tell you this, that there are some countries who still have not recovered from the previous bear market of 2007, 2009, and this is a fact. So if this is happening and this continues, this is going to be devastating for the entire world and for the years to come. So this is the first time that the market is this low since then. So on Christmas Eve, the S&P 500 index closed in a bear market. This is minus 20%, and the NASDAQ is minus 22%. So here we do have a crash because we have a sharp drop in price in the double digits. So this is the qualification for what we would categorically call a crash. So the market is crashing or has crashed. So there are, of course, different explanations of what's happening, and the financial media is pointing to higher interest rates as something that is causing a crash. So interest rates are economic fundamental indicators that tell us what the central bank is doing. So interest rates tell us the cost of money. So higher interest rates mean that the money is more expensive and lending is more expensive. So the whole entire economy will actually cool down. So this is something that could actually be affecting the crash because the central bank is the one that sets the interest rates. The Federal Reserve Bank of America sets the interest rates. So if the interest rates continue to go higher, then it is according to their plan that the market goes lower. So then if this is actually the thesis that we should be following, then we shouldn't be afraid of that because it means that it's under control. And another thing that the financial media is postulating that is causing the crash is the trade war against the United States and China. And this could very well be a factor because this leads to capital flight in different countries where there's more stability because of the cost of goods, because every country is trying to balance out their payments to have a trade balance. So generally, the country with the lower currency rate is the one where people want to conduct business with the most because it's cheaper for that country to for the exporting country to do trade with a currency that is cheaper, because whenever you are exchanging goods you have to go through the currency market, because that is the only way that you can do it, because you have to either pay that country in their currency or they're going to pay you in your currency. So there's going to be a foreign exchange transaction. So the trade war will actually excel or affect the currency rates in both countries, and this affects the entire world economy. So the effects of the tax cuts could also be a factor, because when we're looking at fiscal policies, we're looking at what the government is doing, and these tax cuts are affecting certain areas and certain revenue authorities that are supposed to be offering services to the country. So when these tax cuts are affecting the whole economy, it means that there are other businesses that are suffering in terms of import and export. And another factor that they're postulating is that there's a slowing global growth. So these are the things that the media is saying is causing this market crash, and these may very well all be true or partially be true or be completely untrue, but the very fact still remains that this situation needs to be taken care of. And what we're looking at are some of the factors that do contribute to economic conditions being excelled or being experienced by the general populace. So let's just get a little bit deeper into the situation. So this is the surface of what we're talking about: higher interest rates, trade wars, tax cuts, and global growth. And these are very, very key issues in understanding what is happening in the world economy. But let's get deeper into this issue so that we will see what is actually going on. All right, so here, just one thing that we should actually take note of is the fact that the GDP of the US actually grew by 3.5% in the third quarter of 2008. So with a higher GDP, it means that things are actually looking up, because the GDP, the gross domestic product, shows us the goods and services that are being produced in a country. So this shows us what exactly is going on instead of what we think is going on, because this is the factual number. And if the GDP is growing, it means that the country is good. But then if the GDP is declining, it means that everything that is happening in the country is going to be affected. So all of the other leading economic indicators are also reaching record highs. So here is something that we need to clarify, that the fact that we have a high GDP is a good thing, and the fact that we have indicators that are reaching record highs is also a good thing. But here, when we have record highs right here, right? So if we have these record highs, okay, I don't think we can see that clearly now. But if we have these record highs, that actually means that there could be a possibility that price is overstretched, and that everything that is happening within the economy has reached like a stretching point, because you have to realize that price is like an elastic band. So when it goes up, it has to come back down. So this is a physical law. So there are two physical laws that Sir Isaac Newton presented, which is, the first one was an object once set in motion tends to continue in motion. So this is what we see when we have a market trend, and this is what we have seen since 2009 after the market crash. We've seen that the object once set in motion has been continuing in motion. So this has been what has been happening. There's been growth in the GDP, there's been growth in the economy, there's been growth in the leading economic indicators, and there's been growth in the global economy. Only that now people are concerned that there is a slowing down in growth. So this is what is leading to this. So now when we have a record high, the second law of physics that we need to be in tune with in terms of the market is that what goes up must come down. So when we have a record high, it means that the market has touched an area it hasn't touched before. So it means that it has been expanding itself. It has gained so much momentum that it has reached a new area. So it actually has to take a break and take a breather. So when this is happening, it means that there is a new record, and there's a new way that price is supposed to move, so that it actually cools itself down. So when this is happening, this could actually lead to a decline in the market. So let's actually go a little bit deeper into this and actually go to the nitty-gritties of what we are actually seeing on the charts and what we are actually looking at right now. All right, so this is actually a chart of the Dow that is also on my Tradingview platform. This is courtesy of Tradingview. So here we're looking at we're looking at the Dow. All right. So we're looking at the Dow chart, and we're seeing that there has been massive extended growth within the economy for the past couple of years, for the past decade. Okay, so what we're looking at here at the end is what's happening right now. So what's happening right now, let me get my drawing tool so that you can see clearly. So what we experienced was, first of all, a double top. Can you see this double top? So this double top is actually a pattern that shows a reversal and a reversal in the momentum. So the first thing that we noticed was this double top. And when we saw this double top, we expected price to go back down. But then here, after that, after we saw this double top, we are anticipating that price is gonna show us exactly what it wants to do. And then here it broke this lower level. So this is when we entered into bearish territory, when this level was broken. So you have to also know that there are correlations in the market. So this is a Dow chart. So the Dow is also moving in the same tune with the S&P 500, with the NASDAQ, and with the whole entire world stock exchanges. So even the DAX is showing the same type of correlation. So here we saw that this broke down in the same way that the S&P broke down. So when this is happening, we're seeing that we're now entering into bearish territory after we have a double top. And when this has happened, then we're in a declining situation. So here I just pointed out some situations where we've seen some declines, although these declines are a little bit minor. This is a minor decline. This is a minor decline. And this was a significant decline. And then from there, we've been in a climb. So here, this is what we're actually facing at the current moment. As a technical trader, here is something that I want us to also take note of, is the fact that we have been in an uptrend, and this is the cake, and this is where we make the money. So you see that we have been in an uptrend since 2009 here, since we had the low, and price has been coming back to test this trend line. So it's been tested once and twice. So all of these declines have been coming right to the trend line, okay? So we could say that this is a retest, this is another retest, and of course, this is a retest that came to the trend line, and this trend line is actually rock solid, it's strong. So as far as we can see, we've seen that this trend line is still strong, and price is still above this trend line. So as long as price is on this side of the trend line, as long as price is on this side of the trend line, we are actually still in a bull market. This is what you need to understand. This is what you need to understand. It doesn't matter how long or how many points the Dow declines, but the moment it starts trading in these levels, then we are in a bearish market. And then when we're in a bearish market, we're just going short. So as much as we can tell, we're still in a bullish market, and this is what the trend line is showing us. So these are the technical indicators. So we're not going to be trading technicals in isolation. What we're going to be doing is using these technicals as timing methods, as ways of realizing what exactly is happening in the market. But as it goes, as it stands, we are in a very, very, very steep decline. So this is going to come and test this trend line, and we'll see if this trend line holds. If this trend line does not hold, then we are in a bearish market, and we're just waiting for that old Acapulco cliff dive, right? So we're already cliff diving, and if there is any more room for us to go lower, we're gonna see that. But as it stands, I am looking to see what will happen here. So let's drill deeper into this. So the market moves in retracements and extensions, or extensions and retracements. So which means that it moves up and then it moves down. So these are waves. So price always waves. So price is governed by currencies. So a currency is a current, just like a river is flowing in a current. So these rivers have waves. So these waves are extensions and reversals. So all of these are just governed by currencies, because everything is governed by a bank. So banks are what directs the flow of the currency. So price can go up, but it will go down. It can go down, but it will go up. But not always does it go up after it goes down. Sometimes when it goes down, that's it. But when it goes up, it will go down. That is the second law that Sir Isaac Newton actually spoke about. So when it reaches a peak, it has to correct itself. So this is what we are seeing, that price has reached new highs. So when it reaches new highs, it needs to retrace because it has extended. So when it reaches a new peak, it actually comes back to correct itself. So this is what we could be actually noticing. So this is another chart that I posted on Tradingview on November the 25th. So here is what we were looking at, and I was referencing this area in the beginning, and this area was an area of where the bear market actually began. So we have this shape in the charts, and then we have this decline, and this is what we have been seeing. So this was on the 25th of November. So this is before, this is a month before this happened, and this is what we're actually looking at today as what happened in the past. So when this happened, I was anticipating that price would come back to this trend line, which it actually is doing, and hopefully it will also be captured by this area of of horizontal support and resistance, which is actually the support area because of this red candle that I was referencing. So for more of how I actually got into this trade, I can link with a trading manual that shows you step by step how I go through different trades. So I'm going to link that to the bottom of this video, and then you can go through this and also look at how I select trades and the criteria by which you can also see some of the things that I do. So let's move on from this. So this is a trend line that we actually saw. So here, a trend line fractal is what we were just looking at. That picture is showing a trend line fractal. So trends are a general movement of price in one direction. So when we have a trend, this is what we're looking at, and we have an uptrend. As far as it stands, it's still an uptrend because the trend line is not broken. So trends have to come to areas of support and resistance. So we have three different areas of support and resistance. We have horizontal, diagonal, and vertical. So the trend has to come to these areas of support and resistance from time to time. This is just how the market works. So fractals are fragile fractions that fracture. So this has the possibility of breaking. So this is a very fragile fraction. So this fraction can repeat itself. So within a trend, there's another trend. This is just like a feedback loop. So when it fractures, it will continue to feed on itself. And this is what a fractal is. This is like a fraction that is fractured, and it continues to do the same thing again. And you have to realize that it's very, very, very fragile. So anything that happens today could actually cause a fracture. And these fractions can be huge, even though they might be very, very small. So this is what you would find in the trading manual that I was talking about. So we're looking at those fractals, and so here we are right now. That this is on December 24th. So this is the area, the candle that I referenced. So I referenced the top, but it's actually past the top of that candle. Now I'm referencing the bottom of the candle. And here we're looking at this trend line and seeing if this price is actually going to decline. So you can see this candle is really huge. It's very, very big, very, very bearish. So there's a lot of momentum behind it. So there's a possibility that this trend line can actually be broken. That's a huge possibility. And I'm not discounting that fact just based on the fact that there is a strong trend line that is up trading. In fact, price could actually come all the way to this area of horizontal support. This is very possible because we have this area here, and we also have this area here. And as price usually does, there are always these fake outs, and it could actually even go lower. It could go lower than this point, it could go lower than this point, it could even go lower than it did in 2009. Who knows? But all that I know is that as it stands right now, we're still in an uptrend until this trend line is broken and price starts trading beyond this trend line in this area. So when we see that there's actual areas of resistance that are holding price down in this area, this is when I'm going to accept the thesis that we're actually in a bearish market. So as far as I can see, even though we are crashing, the price is crashing right now, we are seeing that there is an area of support that is really close to this zone. And when price captures this zone, then we might see a resumption in the uptrend. So the confirmation that we're now in a bullish market again is when price breaks this area once again. So this is just how you're going to see the truth about what is going on in the market, and not from the media, and not from me, and not from anybody else, but you're going to see it from the price action itself and the fundamental data as it unfolds. So we're gonna be looking for a break in this area to confirm our thesis that price is actually now back in a bullish market. But before it breaks this level, then we're still in this crashing zone. So as far as this candle is in control, this huge candle, then we know that we're still in a bearish market. So price has to, first of all, defeat this candle and go higher, defeat this level and go higher, unless if it wants to go lower. So this is what we're looking at. So my idea is that the price is still continuing up. So this could be wrong, this could be right, but this is what I am looking at in terms of the world markets. So here we're also looking at the bond markets, which are in correspondence to the entire world market. So the bond market is something that is really unique, because the bond market shows us the credence of the U.S. economy. So as we can see right now, we're actually in a downtrend, and if this trend line breaks, then all hell is breaking loose. And it looks like this trend line has been very, very steep, and it's been going up for a very, very long time. So what goes up must come down. So this is a possible short sell. And this is what we're looking at in terms of the bond markets, because we're seeing this candle and we're seeing this trend line. So if this trend line breaks, then we are we're actually breaking down, and we're going into the bearish territory. But if it, however, holds, then we'll be going longer, and possibly even reaching these historic levels. So we'll see if that is what is going to happen. But this is what we're looking at in conjunction with what is happening in the stock market. So if bond prices are going to go down, then it's going to take the entire economy with it. And as we've already seen, is that the central bank, or the Reserve Bank, is actually responsible for what is happening because of their policies. So when they're doing all of these movements, and when they're making all of these decisions, they're doing this cognizant of the effects of the economy. So what we keep a look we always keep an eye out on the fundamental data that is coming out of the country, so that we actually know exactly what is going on at any given moment. So the Federal Reserve is going to give us the correct pointers of what is happening. So here, if we find an area of demand, if we find an area of demand for bonds in this area, then we're going to see a rise in price. So as it is, we're seeing that the Federal Reserve is the ones who actually sell the bonds. So if this price is declining, it means that they know exactly what they're doing, and they are selling the bonds in order to shrink the liquidity in the market. Because when the market is going up, it has to find a way to calm down so that things continue in stability. This is why we have a Federal Reserve Bank, so that there's stability within the market. So when they are selling bonds, it means that they want to make the economy cool down and become more stable. So this is what we're looking at the current moment. So in terms of what we're going to be actually keeping an eye on from now on to see the effects of this market crash is the country risk. Okay, so the different countries that we are going to be investing in, we're going to be looking at these in terms of the global macro situation. We're going to be looking at political risks, inflation risks, interest rate risk, and credit risk. So all of these things are what we're going to be looking at, and if you keep a bookmark on all of these things, we're going to be going through them and exactly explaining what is going to be going on, and what we're going to be looking at, and what we're going to be considering to be very, very pivotal in our decision-making process and our thesis in entering trades in the coming years. So we have to, so yeah, we have a bond here. So we have to be in line with the whole thesis of that the bonds are going to be in charge of what is happening within the economy. So if we see a decline in bonds, it's going to be a very, very huge signal about what is happening within the economy. So these bonds are going to be tied in with securities, because a security is actually a bond. So the word bond actually means bondage. And what we're looking at when we look at the S&P 500 is a security. So these securities are supposed to be bonds. So people would put in bondages so that they would be in a secure place. So these bonds are something else, but we just call them paper assets, but they're actually something else. And they're also Mr. Sean Connery. So this is what we're going to be looking at, and this is what we're going to be doing. So of course, money never sleeps. So we'll just keep you updated, and I hope that we can be in touch and we can see exactly how this situation unfolds. So this is it about the stock market crash of 2018. We've gone through a great deal of useful information that you can actually begin to use today. And if you think that I left some important things out, please just comment and yeah, just point it out. This is what I would really like, because I am an eternal student of the market, and everything that I can learn is going to be very, very helpful. So I look forward to hearing what you have to say about the stock market crash of 2018. Other than that, if you want to holler at me, do that. If you want to send me an email, do that. If you want to check out my Tradingview, do that. But you know how to find me, and so this is it, and thank you very much. All the best in your trading. Many, many blessings.